Warren Buffett said it best, the most amazing miracle in the world is compound interest.
Mm-hmm.
He looked at every single dollar. If it wasn't compounding, it was a lost opportunity. And if you're earning 7% on every dollar you make, it should double every 10 years, the rule of 72. So what's happening is people start this compound interest curve and then they stop the compounding because they stop it and they go over here and put something else there. So velocity of money works if I can get the compound interest to go and I can use that and then go buy the real estate. So now I'm getting two returns. So let's say I got money that's working for me and growing. And then if I was to use that at a certain, you could borrow against it and you could go buy another asset. But if you buy that asset and you lose money, you just put yourself in a worse situation. So velocity of money works if you have real rules around it, because like, let's say you had that compound interest, I could use it, go buy a piece of property, structure in a way where I get my money back, then I should take that money and go put it back where it came from, and that investment should stand on its own.
Mm-hmm. Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. All right, welcome back to the Doctors Investor Club podcast. This is your host, Kyle Stevenson. Today's episode is a big one because it really sets the foundation for something we're building: InvestRx, bringing real financial education to physicians, starting here in Indianapolis, expanding to Florida and across the country. Joining me again today is Scott Jared. He's the founder and CEO of INVST. He's the author of Accelerate and Future Hack, and someone who has spent years helping high-income professionals rethink how they build wealth and design their financial lives. We went deeper into Scott's background on a previous episode, so if you haven't listened to that, definitely go back and check it out. But today, we're going to focus on InvestRx, what it is and how it will change the game building financial IQ for physicians. So Scott, welcome back to the show.
Thanks so much, Kyle. This is amazing. So happy that you've taken this on as a passion.
Absolutely. Nope, we appreciate you. And, just real quick, we had to move this. And if you don't mind, do you mind telling the listeners where you were last night?
Oh, yeah. It was like one of the coolest things I've ever been. I was at the NFL draft, and one of our clients, friends, family, been with them forever, got drafted by first round to the Chicago Bears. So it was one of the most, if you think about your life's work to this point, like it's to be able to have that moment with someone was just so amazing. And what's crazy about Dylan, Dylan Thieneman is his name. He's in Westfield, where you're from, where you live. And just to see all the Bears fans there, and he just runs off stage into the Bears. He's just doing all that. And I'm like, that was awesome. He just has so much energy. And we're hanging with them at the end. I go, man, you ran in the stand, you got out there and did all that. I was like, man, that was so well played. And he goes, you mean not everyone does that? I was like, no one did that, but you did it. So it just shows you like just the grit this kid has. So it was like really one of the coolest things I've ever got to see.
That's amazing. Yep. And I saw patients today, and we're 2 minutes from Westwood High School, right, where he played. And so it was cool to see some of the patients coming in. Just everybody's excited.
Just wear the draft hat now, like just act like I was there.
There we go. Heck yeah, man.
Yeah, I had it right here in my bag. But it's cool when you see, just think of the physician journey as you go. Athletes are the same. He started 5th grade. He was watching his brothers do the drills, and the same guy developed my kids. Like it was a fundamental pattern of what he did the whole way. And we're coming back, so we flew back into Chicago. We flew from Pittsburgh to Chicago and back, and Shaq's on the phone with the reporter going, these are the disciplines that this kid has. He was at Oregon. He would show up before the coaches so they could let him in. So that's like when you want it and you really want it, but isn't a physician the same thing? So I think it ties so well. That's why I love sports, RX, physicians, business. They fit to me very clearly because they have great stories to tell and it motivates. And I just think I love what you're doing because I think they're building they want to help people live better lives. From their brothers, they're doing vitality stuff. So it fits so well with what your mission but they need people that actually are in the physician clinic world, but there's a business there too. But you're helping humanity. You're abundant thinking, and that's the kind of audience that is just is so awesome. It's just so cool. So yeah, that was just I get goosebumps just thinking about it.
No, that's a really cool experience for you. Amazing. Congrats to Dylan. That's fantastic. He's been a stud. Fun to watch.
Yeah.
And
we'll
to your point,
podcast.
What's that?
We'll get him on the podcast.
Yeah, absolutely. But to your point, I mean, seeing professional athletes, like they're at a different level, right, than physicians. But it's still to your point, like that work hard mentality. You have a mission at hand, and so yeah, you make good money, but do you really know what to do with that money? And that's what we're going to talk about today.
Yeah. Yep. And literally on the flight, I was sitting with a guy in medical school from Johns Hopkins, and he doesn't know where he's going to go in medical. And I go, man, we work with a lot of physicians on that path, that journey. And he was just 50 questions. He's friends with the Rooney family. He was there at Pittsburgh, and he's like, oh, can I come to Indy and intern? And I was like, yeah, we got groups that work with the Colts and all that stuff. And so now I'm like, this really starts to fit really well.
Yeah, that's cool.
Yeah.
That's cool. It's a whole network coming together.
Yeah. Just like what you're doing, especially in ortho, because then, anyway, I can go on for a tangent. But
exactly. No, this is great. And we'll keep talking about this stuff.
I think you said something really important there, is that an athlete is playing on a bigger stage than a physician. I don't think so. I just think they get more attention. I think the physician's they're professionals. Like they put in just as much work. If you think about how many years it took them to get there, actually more, because it's really a similar journey in my opinion, but they are professional at an elite level. I look at our physicians at elite at what they do.
Yep. I would agree with that 100%. And financially, I mean, yeah, to your point, like, professional athletes may only get 3 years on average. They're getting 3 years to make that kind of money. So they really need to be smart with it. Physicians are getting that over a longer period, but they're still making, darn good money in that time. So,
yeah. So you think of a physician, you're right. How do you know money? So this in the NFL, you're going to get it all up front. Hopefully, because it's really not for long. Work. But for him, he's going to get a big bonus, and he's going to get a contract that's really nice at a first rounder. Well, physicians, the same thing. They're just going to get it spread out over maybe a 30-year period.
Yep. Yeah, that actually leads to my favorite quote, and it's by Robert Kiyosaki. It's not how much money you make, it's how much you keep, how hard it works for you, and how many generations you keep it for. So the reality, and I'll introduce this and then lead it into a question. But the reality is physicians are really good at making money, to your point, to what the discussion we just had. But we're not taught how to keep it. We're not taught how to make it work for us. We're definitely not taught how to pass it down, right? So that's the gap. You see it all the time. Physicians make good money. They're making, $400,000, $500,000 a year. Some are making $1.5 to $2 million a year. So they're good at making money, but they lose it all to, taxes, interest, all the things. So a lot of physicians still feel stuck, still feel burnt out. So let's start with that. Why do you think it is that physicians who are good at making money struggle so much to keep it, to grow it, and ultimately create financial freedom?
I think that your uniqueness, I think of unique ability. So what are you going to specialize in? Physicians are very specialists in what they do. Understanding your money is another specialty that I spent my career wanting to understand. And so the physician's journey is, how do you give a physician the right things to consider to make the best choice? And to me, what happens is you're making decisions based off of emotion, not off of using your IQ sometimes. So you're making it best, because it'd be easy if you're just a robot or an institution. You just say, oh, we're just a program the money, but we're human and we have things we want. We work for our family. And what I've learned is to help physicians better understand. They need to understand themselves first and create rules for how this works. But how can you do it in a simplified way to help a physician think about their thinking so they can make better choices? It's all about choices. And how do I break that down so you're thinking of 3 things versus a whole set of things to make that decision? So if I can make your decision tree very simplified and be able to help it go faster, and you have ownership of it, then you know why you're doing it, and you have confidence in it, then that's going to help you in your next journey. Because the only thing constant in life is change, and you're changing. We're always changing, guys. Nature's changing. We're changing. We're evolving. You're going to evolve. And so then there's a money side to it. And when we were doing financial literacy for residents, the component that was missing in there was the financial components. We're trying to fill it, but there was like all this, but there was like this little bit, and it was sponsored by your local wealth management company. So you got to understand, well, what was their agenda? What are they trying to teach? Because they were trained from the CFP designation to help you understand the products that you could buy versus helping you be a better steward of your money. And that is where I think your podcast and your listeners I think that's what they're looking for. And that's what I hear with all the physicians I meet with. And even if you're not a physician, or you're an athlete or you're a business owner or whoever we're with, it's very important to understand that.
Yep. Nope. That's very good. And, to that point, like, let's get into the stats really. So doctors, up to 63% of doctors have burnout. It's for the last 30 years, it's been at least 50%, if not more. And now it's up to 63%. 75% of doctors are now employed, whether it's by, private equity or a hospital or whatever else, they're employed. So they're losing that autonomy, and zero financial education, right? So, let's talk about InvestRx. Let's talk about what sets you guys apart, Invest, than most traditional financial advisors or advice that people are getting. Let's start there.
I would say just from the fundamental of the way the company was designed, it wasn't sizing someone up by their checkbook. It wasn't sizing someone up by how much wealth they have. It was more about, do they want to win? Do they want to take care of themselves? Do they realize that they're the most important asset? They work for their families typically, and they want to have a better future. And if that aligns, then we can help. But that's the biggest journey. So the thing I look at is, can you get someone to really think about their thinking of what they want and help someone live this life that they design themselves? So if I give you a pen and you could design it, well, then you have ownership of it.
Yep.
But that's not what it's always about. A goal, a need. That's not what I'm talking about. I'm talking about, what is a life of significance and purpose? How do you get your money to work for you versus something else? So how do I help you live the life that you want? How do I make sure that your money is working for you? Because you're trading time for money. And if you can design whatever would be the ideal outcome, then the rules and structures that were placed into from, go to medical school, go to residency, fellowship, then go into your career, you're on a path that's got guardrails on it. Like they're designing the path, which is the way it's taught, because universities are trying to train you to go do a job.
Mm-hmm.
What we want to do is flip that around and say, cool, we know their agenda, nothing wrong with that, but isn't this about you? So if you are the centerpiece and we're trying to make you better than where you were yesterday so you can keep building a better version, to me, you start there, and then the financial decisions you make, it's only one component of giving you actual freedom. But if you can't tell me what you want, then it's irrelevant. You're just going to, but you really want your money to work for you. So you want freedom. Like if you say like freedom, you want freedom of your money. So your money then gives you time back because you don't have time. Physicians are way overworked. I don't know what the statistics are on that, but I'm sure it's very long. And then you want and then when you get your time back, who are you going to spend your relationships with? As I hear your Hanyaks in the backyard, in the house, because that's your relationship. And we should be cool. Like, that's what we want for you, Kyle. And then what's your purpose? But those are your 4 freedoms. So what we're trying to do is solve the freedom problem and help money work for you so you can live the life that you want and live in a worry-free world because you're confident in what you're doing.
Yep. I love that. Yeah. Sorry, what was the last thing?
So you can live the life that you design for yourself.
Yep.
On your
terms.
That.
And on your terms. Exactly. And so, a couple of points you made there. Like, I have medical students with me every day, and we talk about this. I honestly talk to them about this stuff more than I do orthopedics, because most of them won't go into orthopedics, so that doesn't really matter. But this stuff will last a lifetime. This is the important stuff. And, to your point, like, you guys start on your presentations, on your discussions, on anything you talk about, it's mindset. It's start with why, right? It's that book, Simon Sinek's book, Start with
Yeah.
Why. What's your purpose? What do you want to become? Who do you want to become? And, most medical students are literally thinking about the next day, think about the next test,
Yeah.
right? Most residents, same thing, thinking about the next surgery for tomorrow. But nobody's thinking about 10 years down the road, 20 years down the road, other than I want to be a hem-onc doc. I want to be an orthopedic surgeon. I want to be a family medicine doc. But they're not thinking about it. And then I get messages all the time because of my podcast. I get messages all the time. And it's usually from people that are, 45, 50, 55, maybe on their way to retirement. They're like, man, I still don't understand taxes. I still don't understand how to decrease that. I still don't understand interest. I still don't understand all these things. Like, what can I do now? And it's like, it's not too late, but what have you been doing for the last 30 years, right? You were just head down, focused on your job. So, yeah, I mean, can you speak to that? Like that's a physician's mindset, right? Is almost, it's like too late because I just have never learned this stuff. So how do I learn it now?
Yeah. Because what's happening is you're going through the journey, you're in it. So, you're working in it versus on it. Mm-hmm. And what's happening is we get to that point and now all of a sudden an emotion happens because usually emotions make a decision. You're moving something. And so then you're like, oh my goodness, I got 10 years left. What am I going to be? So then all of a sudden it like triggers something. It's like, oh man, I've been down in it. And then you start to have this self-realization that, okay, at some point it's going to have to switch where the money is going to take care of me because who else is going to do it? It's not going to be the healthcare system. Pensions are gone. They're out the door. They're going to say, heck, anymore if you don't do your volumes and the way the big systems are working. I mean, it's and the reimbursements but you're just trying to keep up with that. And you come home at 8:00 at night, you dictate and you're doing all this stuff. You got kids running around. This becomes the last thing you think about.
Yep.
And then you do that for 10 years, 20 years, and then you're like, oh my goodness, I just been in it. And I'm like, where am I going to be? I don't think it was intentional by any means. I just think it's just part of being in you're just not really clear on what you want. But if we can start with what you want from the beginning and as soon as we possibly can, then you can move. And guess what? It changes. Like I said, constant change. Change is the only thing that's constant. And so then we're always leveling up. Just like Dylan, right? I got drafted. Do you think it's over? No, your game just started.
Just started. Yep.
You just started because he's on a flight right now to Chicago, and so then the money's coming in. He's like, when is he going to have time to sit down and think about it?
Mm-hmm. Never. Yeah.
Or someone will help him with it, and maybe they're doing it based off of what they want for your money, not necessarily what you want for your money.
Yep. That's a great point. It's a very good point. And, I can go so many different directions, but, physicians, I think we're just always told like, you're going to do fine. You're going to make up the money. You're going to make tons of money in the future. Don't worry about it. You'll be fine. Invest in index funds. You'll retire well. Well, I talk to docs all the time who can't retire. They're 65, 70, still going, right? And there's like a stat out there, and this actually seems a little low to me, but the stat is 25% of 60-year-old physicians are worth less than $1 million. So a quarter of retiree physicians are worth less than $1 million, which is dumb because they've made way more than that, right?
Yeah.
So let's talk about that. I mean, if we can get into, I want to get into a couple topics that you've referenced in your books. The smart guys like the Kiyosaki's and different guys have talked about. And I think one of them that changes things a lot is the 4 headwinds, right? Mm-hmm. Can you discuss those? The taxes, the inflation, interest, opportunity costs. Those are 4 big things that we're losing out on. And I just want to mention, I'm reading this book called The Big Print right now. And it's like, we've printed off 6.8% more money every year on average. So inflation, they tell us is 2%. It's really more like 6 to 8%. Right?
Oh yeah.
And so that's going against everything. That's a headwind. Obviously, taxes are a huge headwind.
Right.
When we, as physicians, 50% of our money is going towards taxes at least. Paying interest, student loans, mortgage, cars, credit cards, whatever. And then opportunity costs. When you spend money, then you don't put it into something else that could have been a good opportunity. So any way to speak to those, how to turn those headwinds into tailwinds?
What's interesting is you're nailing it. And there are 4 what I call challenges to building wealth. And in my first book, Future Hack, I really wanted you to understand that every decision you make, there's only really 4 challenges to building it. And the one you're talking about there is lost opportunity cost. And so I work with Robert Kiyosaki's CPA, Tom Wheelwright, and he wrote a book called Tax-Free Wealth. And it's a really good read. He's actually coming here, I think, in a couple of weeks as we start looking through how to help people understand taxes better. But every dollar you make, you're only seeing a percentage of it. And most physicians are W-2. So if you're making $1 million, let's just say that's a nice chunk of money, but you might as well take 50% off the top for taxes. And if you add it all up, you go, no, my tax bracket's this. Well, did you factor in your state income tax, your local tax, your property tax, your sales tax, let's go through the list. So Dylan being drafted to Chicago is going to pay way more in his career than you would if you were in Texas or in a non. So I was kind of hoping that he would go to a state where there's less tax, because I can't really help in some of that where a lot of that money's going to go. And then they pay tax in every single state that they're in. But when you actually look at your tax effective rate on your tax return, it's just going to show what your income tax bracket was. But you got Social Security tax, Medicare tax. I mean, when you add it all up, it's quite a bit. That's why I was like, you're almost playing 50% money. And then you got to save. So if you don't save 10 to 20% of that, and you're already behind. So now you've got 30% left if you just to set aside this. But then, well, you got your student loan debt, and then everyone's telling you to pay off your debt because that's more efficient. I would say not everyone, but it's very easy for the common person to pay off credit card debt and all that bad debt because you're losing. So by the time you pay off all your debt, that's where your 20% goes. And then you got this 30% that's usually there for lifestyle. And by the way, you got lifestyle creep because you're a doctor, you should be in good schools and neighborhoods and all that. So then you're trying to play with this top 30, and you start breaking it down. It's not like what you think. It really doesn't go as far. And then you got the cost of money getting even more expensive every year.
Yep.
And then you got the pressure from the hospital system saying, oh, you're making too much, and start putting pressure down. And when you start putting on a P&L, profit and loss statement, like if we run you like a business, you're like, wow, that's where it's going. But most people don't even know where it's going. So you can't even start to find the lost money until you go through and get it organized. So that the one thing you got to do is organize yourself, see what's happening, and then we got to go and identify and find the lost money. So for me, the way we started our company, I mean, granted, I was a poor kid off welfare and food stamps coming in. I really don't know anything about money, but if I can help you with it, find lost money, and you just at least got that back, then we can figure out what to do with it. So let's start there. So could we create a world where we just find the lost money and put it back? Well, where would you put it then? So the first rule is how to recapture all the lost opportunity from your car insurance, homeowners, liability, disability insurance, because that doctor that made it to 70 did great. But what happens if the health wasn't there, or they weren't able to do the surgery because maybe something happened and now they're primary care? So all that, you need to find the lost money there too. So there's a lot of money leaking from the way you protect yourself, the way you pay for your houses, the way you pay for your cars, the way you pay for your taxes, which creates the wealth gap right there. Right there's the money. Because if I can find 5, 10, 15%, that money on that $1 million set aside over 30 years could be $20 million of wealth that you lost if it was actually working for you. And $20 million at 5% pays you $1 million.
Yep.
So I'm always like, how do I get you to work optional? Not retired, because retired means you're taken out of use. How do I get you to work optional? So if I can find the lost money, is one of the most biggest challenge you're talking about, then I got to be organized to see where I'm at. So the second challenge is organization. But as a physician, do they teach you how to build a balance sheet? They teach you how to do a P&L. They teach you how to do a protection. So we should be able to take your entire financial life and put it in 19 areas, and then you can measure decisions. So without a financial game board where you can organize it and simplify it, then you're making decisions based off of your who's. Your who's are the people that are helping you. Your CPA, your attorney, your retirement plan specialist, your employee benefits specialist, your car insurance person, your homeowner's insurance person, your investment manager, your business person, your billing person. You have all these people around you, but they never met on your behalf. So this is your board of directors. But they don't. If they don't have the rules, they don't have it organized, then how are you going to play the game? So lack of organization in itself and coordination is a big problem. That's the second challenge. And I don't know how many people on the podcast could be able to tell, literally could pull up where they are right now in four critical areas, from protection, assets, liabilities, and cash flow.
I can personally, because I use your system. Right.
And when you went through that, what did you feel when we could see where you were just clearly, just on one page?
It's amazing. I mean, it really is, because as physicians, like, I used to think high risk, high reward, right? I got to, make up, build wealth by putting in this deal, and hopefully I get a windfall of cash. And then you realize you put it all together, you get it organized, you find lost money, or you just organize it all together. Now you got to focus. And it's like, I can just be consistent with this money that I have here in front of me, and I'll do, and I'll be wealthy just on that alone, right? Then I don't need to take the risks. I don't need to try to hit home runs. But to your point, like, too many doctors have it everywhere. It's just scattered.
So then what happens is a decision needs to happen, and sometimes it's an opportunity. So now you got FOMO. Oh, I'm behind. I got to go put money in this deal or this opportunity, and because I'm behind, so I want to catch up. But now you just made an emotional-based decision without being able to weigh and measure every decision you're making. How do I buy my car? How do I invest? How do I buy real estate? And now what's happening is the third challenge is the rules of financial institutions. Because what's happening is, even in a real estate opportunity, it's an institution in a way, because you're putting money in, and the goal of financial institutions is they want your money. They want it systematically. They want to hold on to it for as long as possible, and they never want to give it back.
Mm-hmm.
So the first day you start your job, what do? You got to max out that 401k. Great. Good for you. So we're going to go max out the 401k. Well, we got high interest rate student loan debt, credit card debt. We're already behind. And guess what? It comes out. They want your money. Comes right out of your paycheck systematically. They want to hold on to it for as long as possible. So if you pull it out, what happens? Well, you can't touch it till 59.5.
Yep.
And then the fourth is they never want to give it back, because when would you ever pull it out? Because if all your money was in this box and you yanked it out, it could be taxed back to 50% again. And like, well, I saved money on taxes. No, you didn't. You are the farmer that is now, instead of paying tax on the seed, you're paying tax on the harvest.
Mm-hmm.
I'm not saying a 401k is bad, but what you need to understand, that's the rule of financial institutions. Insurance companies, they want to charge you as much as possible for insurance and give you the least amount of coverage. You actually want to pay as little as possible for insurance, but protect yourself for the most amount. So the agendas are a little upside down. So you just got to know the rules of the game.
Mm-hmm.
Nothing wrong with it. Because if you know what you want, and then every one of those decisions you're making, you have a way that you make that choice, and it's simplified. Now you're making better choices. And it's not only out of emotion, it's using your IQ, your EQ, and your learning experience. Experience is really important, because you don't have the experience yet.
Yep. Yeah, that's really good. And yeah, I love that. Increasing your financial IQ, because honestly, most docs do have a financial advisor, and they just hand their money off, and then they don't know what happens with that money. They're like, I think I'm doing the right things. But if you don't take control, then you'll get taken advantage of. And the 401k, like, I used to do the 401k, and then, I would always read Kiyosaki, and he was like, don't do the 401k. There's other ways to give you tax benefits. And I stopped doing it. And I feel like I found ways to combat that, because the 401k, to your point, is like, it's locked up. I mean, the 401k didn't come out to the 80s, right? It's pretty darn new. So, I see now those retirees that were the first ones are seeing that their money's locked up, and they don't want to pull it out because they're going to be taxed at a high rate, earned income, ordinary income tax rate. And so there's other ways to give yourself benefit and be able to use that money and not have it locked away.
Yeah. And it could be just the way you do things in order. Like, I'm not saying it's bad, but like, it's really hard to build after-tax wealth, because that's the fourth challenge. How can you get $1 to do multiple things?
Mm-hmm.
So if you take your money, deposit at the bank, what's the bank do with the money?
They loan it out and make more money.
Yeah. So today, the risk-free rate is like 4.5%. So every dollar sits on the bank's balance sheet, they're making 4.5. So if you put money in your checking account, they're paying you probably not 4.5. So what are they doing with it? Well, first of all, they're making the float. The second thing is they use your money and they can borrow 10 times that dollar. So they're going to the Fed, they're able to use those dollars, and they're loaning it out for cars, student loans, all the stuff that you're a consumer brand. So doctors are very good consumers. They're great. So now they're loaning it back to you, your own money. Give me your money and I'm gonna give you money for a car loan, but you're not paying me on my own money.
Mm-hmm.
And then what happens is you're not able to use that money multiple different ways to create all the same streams of income like a bank does. So the velocity of money is really important. But if you're a physician and you get a blood clot, that's bad. Like that could be bad. And if your money can't flow naturally and work for you and be in motion, what happens is it's only getting one spin on the dollar and you're already behind. And we could almost accelerate that and take less risk by finding lost money. Organize yourself, make better choices, understand the rules of the game, and make your money velocitize. Yep. And then once you start going, then you come back in the 401k because you get things in the right order in that way. Because it is still a free, like if you're an employed company, a lot of times those employers are matching.
Right.
And the reason why you said back in the 80s, they went off and they created the 401ks because the companies didn't want to do defined benefit plans. Defined benefit means work for me for 30 years and I'm going to give you your income for the rest of your life. Well, that risk was sitting on the corporate balance sheet. So they just said, I don't want to take the risk. They just transferred it to you by giving you a 401k.
Mm-hmm. Yep.
That's the education component. Just understand the game. That's all we're playing.
Yep. On that 401k, I mean, I've read Ted Benna's book or he's at a forward in a book, but I've listened to him on different things, and he's the creator of the 401k. And he basically said it was always supposed to be a supplemental plan. It was never supposed to be the primary retirement plan. So
yes. And we have a 401k division, so we do tons of them, but we still want the employees to understand what's the right order, because even there, if you're not happy, if you're going to work and you're stressed about money stress and you got problems at home, then you're not going to show up the way you need to show up to do what you're supposed to do. So we actually use the 401k as a literacy program to allow the business to help their employees understand their why a little bit better. And what happens is then they become better stewards and it builds enterprise value for the company. And so we're trying to help the company build value with its employees, but you're only as good as your employees are anyway. But I think Big Health, they don't really see it that way. They're just trying to check the box of all the benefits we should provide. Yep.
No, very good. So get organized, very important. Number 2, protect yourself fully, right? Number 3, I mean, I want to lead this into velocity of wealth because I kind of want to go through the logistics of velocity of wealth, if you don't mind. So what would you say after protect yourself fully?
Okay. So what I would say is there's 3 things you must do.
Yep.
You want to get yourself organized, because if you're not organized, you don't really know what you're protecting. And what you're protecting is your ability to go to work and do your role. So like if you're making $1 million again and you got sick and couldn't work, would that $1 million come in or not? If you were to drive down the street and you got hit by Budweiser beer truck, would the $1 million maybe, because maybe Budweiser could pay the difference of what you lost if you go hire an attorney. But if it's not Budweiser and it's someone without car insurance, would it work? Mm-hmm. What would happen if you hit somebody and they come after you? Would it work? So the protection thing, that's controlling your controllables, because we could control if one of those scenarios were to happen by just protecting it. So having the insurance company pick up the catastrophic risk, we'll take the small risk, transfer the big risk to the company. But then the reason why people don't do it necessarily is because if the employer said, I'll protect you full for all your value across all 4 domains, from your liability, protect your income, legal, and your life, and the company said just check the box to get it, everyone would check the box. When they don't check the box, is because it's a cost.
Yep.
That's the problem. So then you're like, well, I don't want to pay for it, because if I pay for it, then you are going to be behind again. So it's organized. If you're organized, protect yourself, because I can control that. That could actually be your offensive strategy that allows you to pay yourself first. Yep. Because you got to know the cost of business. But if I can find lost money leaking out, and then what happens is money comes in the checking account, and I don't know if you're like our house, if it goes in the checking account, it finds a home pretty darn quick. And if you're not paying yourself first, then you're behind. So that's like the whole concept that Rich Dad Poor Dad talks about too, is like, if you're not setting stuff aside, because all you're doing is setting money aside for delayed expenditures anyway, because you got inflation, planned obsolescence, everything that you buy, like your refrigerators, washer and dryers are designed to break, technological change. You got to keep up with the new technologies. You got to get a new phone and all this stuff to keep up. And then you got just normal living expenses. And then you got cost of living. So all 5 factors at 3% of each one, that's 15%. So everything you're setting aside is only for delayed expense anyway. And that could be the retirement. It could be for an emergency. It could be for whatever that is. But then you live that. And then when you pass away, well, what did you leave your family? What if I could give you back every dollar you ever made and be able to enjoy your wealth at the same time by using a risk management strategy?
Yep. Then you have permission to spend, right?
And then you got permission to spend. But you can't do velocity until you pay yourself first. You're building. So like for you, you made a decision that you want to build after-tax wealth. So you can then take advantage of other assets that are outside of a box that you can't use. And then once that starts to work, then you can come back. But if you don't have a year of liquidity, if you still have bad debt, if you have a lot of those things going on, you're doing things out of order, you're just making it worse. You're just prolonging it. Maybe. Because what you got to do is you got to put it on a model and say 401k, option A, no 401k, option B, pros, cons.
Yep.
Here's what it looks like in time. And then you make a choice.
Yep.
Just like you would look at an x-ray and go, yeah, it's torn. I got to do the surgery.
Exactly. Yeah. No one size fits all. It is customized to each person that comes to you, and especially for physicians. And again, that's your bread and butter is you guys work with physicians, you work with business owners, you work with athletes, a lot of professional athletes.
Yeah.
And so, yep, you work with a lot of these people that are in the same boat to a degree, the same pain points. But, real quick, so like the velocity of wealth thing, I mean, to me, that sets you guys apart. I love that concept, and I love how you do it. I mean, I'm speaking to Indiana State Medical Association next week, and we're going to discuss it as well. And it's always eye-opening when I talk to medical students or residents about it, just how you can use that $1 multiple times. And they're always flabbergasted when I bring that up. But do you mind explaining velocity of wealth just in a nutshell?
In a way, yeah. So for instance, we here at Invest, we manage paper assets, which is like what you would say cash, like your cash on hand, flow of money, investments like your traditional stocks, bonds, ETFs, all the stuff that you would manage paper. Then you have hard assets. Hard assets are not marketable, if you will. So that's investing in your practice, investing in your real estate, the business, investing in I'm thinking about your business. So you think about a physician's practice, from surgery centers to your practice level to the real estate itself, stuff that you actually control. Then you have other people's investments. So a lot of people come on the podcast like, invest in this multifamily, invest in different types of real estate. So for us, we built a very sizable real estate portfolio by using this velocity of money concept, but we don't let clients come into it unless they understand the right way to invest. Because if they don't understand the right way to invest, then it may not work. So for instance, Warren Buffett said it best: the most amazing miracle in the world is compound interest. Because he looked at every single dollar. If it wasn't compounding, it was a lost opportunity. And if you're earning 7% on every dollar you make, it should double every 10 years. The rule of 72. If it's earning 10, it's doubling every 7. So just really quickly, I could sit there and go, you're saving it. I could tell you what a compound interest curve would look like. So what's happening is people start this compound interest curve, and then they stop the compounding because they stop it, and they go over here and put something else there. So velocity of money works if I can get the compound interest to go, and I could use that and then go buy the real estate. So now I'm getting 2 returns. So let's say I got money that's working for me and growing, and then if I was to use that at a certain, you could borrow against it, and you could go buy another asset. But if you buy that asset and you lose money, you just put yourself in a worse situation.
Yep.
And the trick is, in the Rich Dad Poor Dad book, Who Took My Money, which is the one that really hit me, and he talks about it there. He's like, be the gambler. We took our kids to Puerto Rico, and we went to the casino, and each of them got $100. Well, 50, I guess they got 50. I took 100, and we sat down at the blackjack table, and we let the guy kind of help us. And what I saw was the boy. I mean, they're just turning 18, and I saw him when they would win. I'd see him put a chip to the side. I was like, "What's that?" And he goes, "Well, that's the money I started with." I was like, "How'd you figure that out?" And I go, he's like, "Well, I just don't want to lose money." I go, "Okay." So the gambler mentality is when you win, play with the house's money. So I saw him setting the chips aside. I was like, "You're exactly right. That's being the gambler." So you're taking your money off the table, and you want to get it back sooner than later so that way you can play the house's money. Yep. And now your risk is very low because you've got your money back. So velocity of money works if you have real rules around it, because like, let's say you had that compound interest, I could use it, go buy a piece of property, structure in a way where I get my money back. Then I should take that money, go put it back where it came from, and that investment should stand on its own. Mm-hmm. So when I look at it, I don't look at the real estate as being good or bad. I look at a few things. What's my collateral? What's my period of time? When do I get my money back? And am I getting a return that's better than what I was doing with it before? But I should still get the compound interest. So it better work better than a marketable security. It better have those features in it and have a world-class operator. They don't take my money, because you can't do a good deal with a bad person. Mm-hmm. And a lot of these funds are set up to like never give you your money back. They fall apart. It's not their problem. They have no collateral. They have no skin in the game. Yep. So I'm like very strict on those rules. Like, yeah, here's the deal. If I'm going to give you money, can I have your house? Is that cool? If they sign off on that, like, all right, this guy's serious. So yeah, I mean, that's a really good question to ask. But those are how I could go and have a compound interest curve that's going. I use that. I have another one, and I have another one, and I have another one. Some people think it's risky because you're using something there, but that's how money works. Because if you understand how money is created, you're basically building out of thin air, and that's what you're doing. But you can't play that game until you really understand it well enough. And we got to have the plan when it doesn't work out. And I'll tell you what, it probably won't work out sometimes. So you better be able to hang on and be able to work your way through those decisions so you don't lose.
Yeah, no, that's great points that you bring up. And I've been studying this now for the last, I don't know, so many years. And I definitely, I speak to the DIY guy because they're out there. And a lot of physicians, I think, are DIY, don't want to hire somebody else to do it. And, I've been learning all this stuff, and I'm like, oh my gosh, yes, this is cool. You can do all these things, but you can get burned, and you can over leverage yourself too. And so, yeah, the wealthy don't necessarily sell their stocks or sell their real estate. They borrow against, and that's how you can get away from being taxed. Yeah. But also you put it into something that's negative, or you lose that money, then it's like now you're over levered because you can't pay yourself back. So you bring up great points, and that's why it's nice to trust somebody like you who does that due diligence.
The first rule I try to look at, what if it's not stocks? Is there a way to do it with no risk? So then you look at the other option. Is there a way? Because sometimes compound interest can backfire on you because then you have compound tax.
Yep.
But they don't show that. Like, if, for instance, if we put your balance sheet together, they say, oh, I got $1 million in my 401k. No, you don't. There's a silent partner there that they're not showing on your balance sheet. There should be a line item showing this is how much taxes due if you were to cash that out. Mm-hmm. They don't show that. It's a phantom. They don't show that typically on a balance sheet. So but you got to understand those components of the game.
Yeah. Yeah. And I think physicians need to understand this because, truly, if you want that exponential curve, like just putting it in stocks is not really doing that because the volatility, right? Volatility interrupts compounding. Taxes interrupt compounding. Pulling money out of the stock market, which most people don't do, but paying, a 1% fee every time, that all interrupts the compounding. So if you're just doing stocks, I think that's a problem because of all that. And you can speak to it. Gary Gunderson actually had a really good post today talking about that. It's like, if you make 15% in the stock or S&P 500, well, you're not really making 15% because you're taxed. You're spending this much on your, financial advisor, this, and this, and it all adds up, right? So you're really not making 15%. Inflation's 5 to 8%.
Yeah, so you have inflation, and then you have a risk-adjusted rate. So if the risk-free rate's 4.5, anything over 4.5 is risk. So then you're measuring how much risk is that? Because if I'm saying I can go right now in a money market, earn 4.5, a stock then should earn a risk premium on top of it. But then you got the cost of doing business. You have a tax, you have the management of that, and how all that works. You just got to calculate it in.
Mm-hmm.
But so the DIY, so sometimes when you do it yourself, you still don't have the way to measure that, and then you make decisions based off of emotion. So when the market does pull back 50%, and you say, "Oh no, now what do I do?" Now you make a decision that you exit because you didn't know, you weren't already anticipating that.
Mm-hmm.
And so to me, like the market volatility is just part of the game. The problem is you're a human, and people have needs. So if you're doing that right before retirement and you drop 50%, you got that 10-year window, and then you start making emotional based decisions because you need that money. But you didn't have a plan B. So to me, I would rather start with zero risk. What could you do with zero risk and make it work? Don't do risk until you should. Yep. Then we add. But we could do it with no risk, and you could use other types of vehicles. Like Garrett does a lot with life insurance. I've seen him on the podcast where you can use a mutual participating company that usually pays. I mean, every year I've seen it, those companies are always paying over the risk-free rate. Mm-hmm. So right now, like Dividend on a high quality insurance company that you have ownership in is paying a dividend higher than the risk-free rate. Yep. Almost every year. And very rarely does it go below, because what they're doing is their money's sitting at the risk-free rate and they're paying it back to you. When people don't die, they give you back the money in a form of a benefit. When they make profits, they give you back the form of a benefit. And other subsidiary products they're selling, they give you back, and you own the company. So you're going to earn, like today, like a Mass Mutual contract's 6.5%. It's like a 2% spread on the risk-free rate. And then you're protected. So you could do something like that. But once the dividends are released, they can't take them back because there's no market. That's where Garrett's saying is like, compare that return to S&P 500 with taxes, and you add up no protection. You add up the advisory services fees. So now you're comparing those two together.
Yep.
And then, but then the solution is, let's overfund it. Okay, great. What'd you just do? Well, I don't want to take the risk, but then you just gave the insurance company more money than what you should have for it. And then, so you're giving them more money, and then you're getting less benefit. But we just said that agenda for the insurance company is pay as little as possible for the most coverage. So then now you're like, oh, what's that mean? So you see how the decisions stack. Yep. Now we look at both again. But what if you could get both? What if your stock portfolio had 50% bonds in it and 50% equities to manage volatility, and that 50% was something that was less risky than bonds? Now you can take more equity risk, let that work for you, and get the protection, then velocitize it. Now you're cooking with gas. Now you're doing an asset allocation that's looking at your mortality. You're looking at your protecting yourself. You're finding money that you were paying on insurance, and now you got back. That's a cost savings. And that's what Garrett's trying to talk about in the way he explains it. And he does a really good job with that.
Yep.
And he's going to show you all the different ways to do it. But at the end of the day, what's it going to work for you? That his job is to help educate you. But then if you're out of model, how are you going to make the right choice for yourself?
Mm-hmm. Yep. No, I love that. I mean, honestly, that piece of what you just explained, like, I think that's the brilliance of you and what Invest does. You guys have that dialed in, and you're obviously a very smart guy when it comes to this stuff. And that's what I love about it. You've had experience, all these years. And so it's like, as a physician, we should focus on being a physician. Let the smart people like yourself, focus on handling, helping us get wealthy. Right.
And you see a difference now between like a company that's focused on you, helping you make better decisions, helping you live the life you want, versus this product's going to solve your problem.
Yes.
Now, we know we're using financial institutions in certain ways, and we need to make sure we have the best to have access to, but I don't work for them. I work for the client, and I want them to have an abundant life, living the life that they want. So the difference is just philosophical. Yep. Just like it's an abundant difference that's pure in nature. And that, to me, is the biggest difference, because you can take the advice and go do it somewhere else if you wish. If we're not, but the decision that you're making is what's important.
Yep.
It always comes back around somewhere, and that's just how we've been able to run this, and that's just part of our core values.
Yeah. No, I love it. And it's funny, my father-in-law and I had a great conversation a few weeks ago over some bourbon, of course, but Gosh, I think we stayed up till midnight, latest I've stayed up in years, just talking about this stuff. And he's like, Kyle, if I knew all the things that you know now, or that, talking to Scott, like if I knew that stuff 30 years ago, how much better off I would be right now. So it was just like awesome conversations to hear it from a retired orthopedic surgeon.
And that's true. If you ask Warren Buffett, what would if he could give all his money away, what would be the one thing he would want? And he'd probably say, be your age again.
Yep.
He's right, because he's got the wisdom now. Imagine what he could do if he could go back in time and just reset. Yep. And it's like, if you had your 3 wishes, which one would you wish for? And because he knew he could do it faster, better than we would. So our role from Physician RX and the experience we have working with our clients is we got to pay it forward. So how do we shortcut it for you? How do we give you the tools, disciplines, and the core philosophies that you can do to help you do it faster, better, and then they hopefully they pay it forward, and then that's how you start to make a better. That's your purpose. That's my purpose, and I think it's just really awesome seeing people win. So now for your father-in-law, all right, cool. We know the game we're playing. We got the clocks here, and we're just going to play the game this way. And what I have learned when you're sitting down at 2:00 in the morning with bourbon, it's bourbon in, wisdom out, man. So he's spot on. Whiskey in, wisdom out.
There you go. I like that. And the last thing too, and just going back to that quote, which I love that quote. It's just that Robert Kiyosaki on, it's not how much money you make, it's how much money you keep, which we're learning about today. How hard it works for you, also learning about today. And then how many generations you can keep it for. And, like what would the Rockefellers do? Great book by your buddy Garrett. But just not even just handing money down to your kids. That's not what it's about. But it's educating your kids on this stuff, so you gain your financial IQ, right? Talk to Scott and try to understand these things, and then have those conversations with your kids as they're growing up. And that's the best way. Just like your son, he was making the right move because he's had those conversations with you. He's seen you do it.
Yeah.
And so that's how you really pass down generational wealth. It's not just handing them a bunch of money, because that's going to go away at generation 2. It's the knowledge, it's the values, the practical steps.
Mm-hmm. It's your DNA. I call it like your DNA. It's how you're wired. It's the life lessons that you do, that you want to instill down your children, because you want them to be better than you. Like typically the dad, for a son, like there's not many people that say, I want you to be better than me, but a dad. But being able to make better decisions and better life, you don't want to just hand them a bunch of money and then make them worse off, because the ones that are most happy are the ones that had to go through some adversity. Like, I think there's a lot of that changing that's happening, and how you deal with change and how do you get through it is what makes you better. And so like, if you don't set that up in advance, and you don't really teach the next generation how to be good stewards of whatever it is, you could be doing more harm than good.
Yes. Yep. So we're finishing up here, and just a couple points I want to make is, we're learning about money, and life's not all about money, right? There's purpose, and there's peace of mind, and there's, presence with your kiddos, and proximity, being around the good people. Life's not all about money. We know that, but freedom is important. Purpose is important, and you don't want to be stuck in maybe a job or an opportunity, or maybe a job that maybe you're not happy in. Like if you can get work optionality or freedom in 10 years, wouldn't you choose that over saying I'm stuck in this job for 30 years potentially? And, maybe your situation is you're hospital employed and you're like, man, I want to start my own business, but I just don't have enough runway to do it. I think these things are what can help you get to that point, right? Work optionality and freedom are really a big thing, right?
Yeah, I mean, if you can, it's like a vision board. You put it out there, you put it in the universe, you start telling people what you want, and you'd be surprised how it happens. And that's intentionality and being focused on it. And if you're focused on those outcomes, it's gonna work itself out at some point. Because I've never put anything on a board or anything that hasn't happened in my life.
Yep, that's great. Well, good. All right. Any closing thoughts for physicians? Any practical steps they could do over the next 6 months, or anything that you would just advise them on?
Yeah, to me, the 3 things you must do is organize yourself, If you don't have a tool to do that, we'd be more than happy to give you one through the podcast. Here's access, and you could start to get yourself organized. Next thing was understand what your risk is. Like, where are you exposed? Like, so to protect yourself, like at least know where you're exposed. So that's your protect yourself. And then what is it that you need? Should you be paying yourself first? So it's not what you make, it's what you keep. But if I was going to leave you with something, those are the three things. So let's just simplify it to those three. And if you are aware, that's a good first step.
That's great. Yeah, we appreciate you coming on, Scott. I know you're a busy guy, and you were in Pittsburgh last night. Maybe got back today at some point this morning.
Yeah.
But yeah, you're busy, and but I'm excited with what we're doing with InvestRx, and really just getting back to educating the next generation of physicians, especially these young residents who need to think about this stuff and aren't getting educated about it. So I think that you're making a big impact, not just in Indianapolis, but around the country. And so we appreciate you. Where can people find you?
They can go on invest.com, INVST.com, and they're just like, you could go on there. You could just say, I want to talk, and you could click on a link, and there's a way to say, hey, send me my dashboard. You just put some basics in, and I'll send you the information that you may need. My email is scott@invest.com, and you can just email me too. And the thing is, we are, I'd say, not necessarily busy, but very productive. So there's a lot going on, but we are going to make time for you. And that's really important. And we've got a team here dedicated, and we can only do it we can't do it alone. And it takes a village. And that's where like you being passionate about it. And that's collaboration. And that's why I'm so grateful for you taking this on, because I can only do what I do, but we got to be able to help people in that way. But that's the best way to just get started. And to me, it's just getting yourself organized and start there. I mean, no strings attached. Like, it's just that easy.
Mm-hmm. Yep. Nope. That's awesome. Well, we appreciate you, sir.
Absolutely. You too. Keep up the good fight.
Yes, sir. Let's keep it going. All right.
Yes.
We'll talk soon.
You too.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.